and welcome to Market Domination. I'm Julie Hyman, that's Josh Lipton, live from our New York City headquarters. We got 1 hour to go until the market close and until we get the latest earnings reports from Apple and Amazon. Let's take a look now at the major averages to see how we're setting up today. And Apple and Amazon, of course, coming on the heels of Microsoft and Meta, which are helping boost the market today. So we've got the Dow higher by 233 points, up about 0.6%. The S&P 500 up 1.2%, and the Nasdaq Composite leading gains, as you might expect with large cap tech, up 2.1%.
Yeah, I mean, Microsoft and Meta are big stories today. I remember heading into those reports, Julie. There had been some concerns and nervousness just because of the backdrop of unease and uncertainty out there and what they were going to say. And those were both good, solid reports. And those stocks are sharply higher in today's trade. And kind of the broader message there from Microsoft is basically telling you enterprise demand looks resilient. Now, you could argue that might not have been so surprising. I mean, only 9% pop. Because we did hear from names like SAP and ServiceNow, Alphabet, those were all better than feared. I would throw Meta in there as well. There have been some concerns there. Again, because of the macro, the backdrop, what did that mean for online advertising? It's strong for Zuckerberg.
Yeah, so really interesting numbers from there. But when you talk about the backdrop, something else I want to point out, and I want to go back and take a look at where treasuries are today, because we did get economic data once again this morning that was not great. We had ISM manufacturing coming in showing continued contraction for the second month in a row. It was a little better than estimated. But then jobless claims, in particular continuing claims at their highest since 2021. So that coming ahead of the jobs report.
Tomorrow.
And just something to continue to watch. We got a yield actually ticking up a little bit, interestingly, on that, or maybe not on that, but ticking up today. And then I want to mention what's going on in crude, too. We saw it close a little bit higher today. And there were some headlines just in the past half hour or so from President Trump saying that the U.S. is aiming to apply secondary sanctions on nations that buy oil from Iran. And as you and I were talking, as you pointed out, China's pretty much the country.
China. It's a shot at China.
Yeah.
All coming, by the way, with WTI sub 60 here.
Yes.
But it's a shot at China. Now, one quick caveat is you have a social media post, and so you're kind of waiting, does post become policy? We'll see, but it's a big shot. And also on the calendar, by the way, Monday, May 5th, the OPEC meeting, so a lot for oil investors to digest.
Yeah, definitely, and a lot to consider overall. But let's talk more about those earnings that we have yet to get. Apple and Amazon after the close today. Joining us for what to expect, Yahoo Finance tech editor Dan Halley back with us again. He is earning his paycheck this week. Dan, what are we looking for today?
Yeah, let's start out with Apple. The big thing here is going to be tariffs and how much of an impact Apple thinks that they will have or did have when there was the buy-up, the pull forward that people may have done ahead of the announcement that there was an exemption. So we're looking for any kind of highlights from Tim Cook and company to tell us, okay, we saw XYZ, this is what we expect to see in the coming quarters as far as tariffs go. This is how we're preparing for them. Again, there's an exemption right now for Apple's, as well as anyone else that makes a smartphone, laptop, desktop, computers in general. But the Trump administration has said that that exemption may not hold when they announce semiconductor tariffs in the future. The other thing that we want to look at, obviously, is China revenue. That's one of the big deals that we're always checking out. Has not been performing well for Apple as of late. There's been different discussions as to why. Is it because there's better options for the likes of Oppo or Huawei, that Apple doesn't have its AI capability set up yet in China? Is that making consumers there not want to buy in? It certainly isn't getting people excited here, despite it being out. And then obviously, iPhone sales. That's going to be the other big thing to look at, just more generally. Now, there's the expectation that iPhone sales will be lower year over year for this quarter, but they'll be overall revenue will be boosted thanks to iPad, Mac services, and the whole wearables, home shebang category that they have. So Apple really it's going to be potentially a mixed bag if we see iPhone sales fall. Obviously, that's the main metric that everybody looks at, but China's also going to be in there. And then, again, any kind of tariffs impact that Tim Cook and co. can give us kind of insights into.
What do you think on the call down? I'll be curious to say, obviously, what they have to say about guidance and how they talk about guidance, how they frame guidance, given as you're laying out there, the backdrop here, the tariff backdrop is so fluid and uncertain right now.
It's interesting, right? Because you listen to, the Googles, the who else reported, Meta, they're basically saying, okay, they've said that they're going to continue spending, that they don't see any real issues. The one thing that we had seen from Meta and Google was a potential slowdown in ad sales, specifically from Asia, and that's likely related to just a slowing down as a result of Temu or Shein and the de minimis exemption change. That's where we've seen any kind of potential headwind has been that really. But besides that, they're saying things are basically hunky-dory right now. Now, I will caveat that with saying that Google had said, look, it's April, it's too early to really give too many insights into our current quarter, to which I would say, okay, but other companies are giving their outlook for the current quarter as well. So you can give us a little bit of something. And then obviously, when it comes to Microsoft, the three of those, again, still spending heavily on AI. So that's the software side. But Apple is a consumer company, right? They're not an enterprise company like those focus on. So what does that mean for them? Well, when you looked at Intel's earnings, they saw a pull forward of PC sales, right? So now that's going to create some lumpiness with regards to comparisons in the coming quarters, or what does then that mean if tariffs come into place again on their devices? So I think that's going to be one of the big things on the call is, was there a pull forward on iPhone sales? What does that mean then for the coming quarters when it comes to sales? Are you going to see a dip as a result because the next quarter has been spoken for, Q3? People went out and bought already. So what's that going to do then for overall iPhone sales moving forward? And, it's getting to the latter half, we're getting towards the midpoint of the year. Typically, iPhone sales start to slide then because people are waiting for September and the next phone to come out. So, yeah, I think that's going to be the biggest kind of thing that everybody's going to be looking for.
And then, of course, tariffs will also have a big influence on the other company that we're waiting for, which is Amazon.
Yeah,
right?
I mean, look, that's going to be, I think, the real telltale when it comes to consumers and tariffs and what it means for them. But God forbid you put any kind of notification on there about how much tariffs are feeding into what you're paying. You'll have a nasty phone call from the president, apparently. But that's what everybody is really trying to pay attention to is, are those little purchases that you make on Amazon? I just bought curtains because my cats hate curtains, I guess. So I bought new ones. They were relatively expensive. Tariffs start to come into effect. Well, I start to see those fall, a rise in price. I've been doing a lot of, little knick-knack shopping that I might need just to get ahead. Are other people doing that? Are they seeing more pull forward, as I explained with Intel and potentially with Apple and the iPhone? And then the other thing, obviously, is AWS. And are they continuing to see customers go ahead and buy up? Both Google and Microsoft said, customers are keeping on. They're not, pulling back on anything at all. So that's going to be one of the questions as well. Are they seeing the same? And then are they sticking with their CapEx guidance that they've given for the full year? Now, Microsoft, Google, Meta all said, yeah, we're still plowing money into this. So it would be odd if Amazon said they weren't. They also said they were investing the most, $100 billion. So we'll see how that plays out. But it comes at a tricky time for Amazon just because of the whole tariff kerfuffle the other day, we'll call it.
Yes, we'll see.
All right, Dan, thank you. I have a feeling we'll be hearing from you
Once or
a few
twice.
times today. Once or twice. Stocks are higher ahead of the closing bell today, led by strong earnings from Microsoft and Meta that have eased some fears surrounding big tech. For more on the latest market moves, let's welcome in now Melissa Brown, SimCorp Managing Director of Investment Decision Research. It is good to see you as always. Let's start with the earnings there. We heard from Microsoft and Meta as we were talking about with Dan. Investors clearly like what they heard from those reports. Those stocks are sharply higher in today's trade. After the bell today, you got Apple and Amazon on deck. Maybe start big picture. Walk us through, Melissa, what you made of this earnings season. What have been the lessons learned from you?
Well, I think earnings season so far has actually looked pretty good. In another environment, I might have been quite enthusiastic. We're seeing great earnings. But, as you were just talking about, some of that pull forward that's being reflected in current earnings and some of the comments about not really being able to plan for the future, because we don't know what's going to happen with tariffs. I think that's put a little bit of a damper on the enthusiasm you might have for the earnings that we've seen so far.
And certainly a lot of companies have been talking about the tariffs in their numbers as well. So we've had a couple guests on, Melissa, who have said, you know, even if things aren't going to make much progress from here in terms of the overall markets, maybe we've put in the lows for the year. Do you agree with that? And if so, kind of what does this action now look like for the next several months while we wait for more tariff news?
And I think it's that waiting for the more tariff news that is really the issue. I think we've moved from a market that was quite enthusiastic about, you know, perhaps reduction of regulations and things like that, a more business-friendly administration, to more uncertainty as the specter of tariffs came out, to what really is more confusion now, because we don't really know what is going to be happening going forward, which to me puts, maybe puts a ceiling on stock prices. Things could, we could just not go ahead with tariffs and, things might be, fine. But I still think this state of confusion, what's going to happen, for that 90-day pause, is that going to be unpaused or just done away with? I think that is making it very difficult. Not that it's ever easy to forecast the market, but I think it is actually particularly difficult right now, maybe more difficult than I've seen in my career.
Melissa, how would you broadly characterize valuations right now?
I think, valuations, PE ratios, for example, have come down. So valuations look a little bit better. I still don't think that they are reflecting, great news going forward. They're still relatively high as compared with where they've been historically. And so, and then again, we still have that big question of earnings. What's the denominator of a PE? And again, we come back to this, kind of confusion or uncertainty about that, which makes even valuation levels suspect. Are they right if you're looking at trailing earnings? And do we even know what expected earnings are?
Well, we've had a couple of companies, rather large ones, that have come out with some forecasts, right? I'm talking about Meta and Microsoft in particular. Do you think in this environment that investors should be taking a renewed look at large cap technology, given that, maybe they will be less exposed, or do you even see them as less exposed to what's going on?
I think certainly the fact that they're big, that they're probably more resilient, if, we do see a resurgence in inflation, for example, they may be able to navigate that a little bit better. I think we've already seen, investors coming back to some of these bigger tech names. But, on the flip side of that, going back to the valuation question, they're also more richly valued than most other stocks in the market, which makes that still a tough decision. Are investors already projecting that they are going to be the earnings winners for the rest of the year? And that's already reflected in stock prices.
Melissa, you have a sentiment measure over there. You call it ROOF. ROOF is the acronym. What does that stand for, Melissa? How does that measure work exactly? What's it measuring and what's it telling you right now?
So ROOF stands for risk on, risk off. If you can get the letters out of that. And it's a measure of market sentiment that basically looks at how investors are behaving, what kinds of stocks they're buying. Are they buying cheap stocks and high dividend yield stocks, which suggests that they may be more risk averse? Or are they buying, utilities, which also may suggest they're being more risk averse? Or are they, buying the kinds of stocks that suggest that they're really risk tolerant and risk seeking? And so we look at this on a weekly basis, and it's a relatively short-term measure. But what we've seen is that, particularly in the U.S., this measure of sentiment has gone from being what we would consider to be, slightly on the south side of neutral to really being more negative. So we are seeing investor sentiment start to fall, I think, along with consumer confidence and some of the other measures that are trying to get at, kind of similar ideas. So the roof scores, just to reiterate, in the US have been falling. The only place where we've seen them actually meaningfully improve is in China.
Is that score, though, a contrarian indicator? I know some of those sort of investment sentiment indicators can be.
Our take on this is that when investor sentiment is negative, it means that investors are more likely to overreact to bad news and underreact to good news. So it's not necessarily a contrarian indicator because it depends on what news is going to come out. But the expectation is that with the U.S. in negative territory right now, it's going to really punish bad news. And maybe the flip side, which would make it kind of contrarian, is not react quite as strongly to positive news, which means that there's still room for stocks to grow when the news is positive.
Gotcha. Melissa, good to see you. Thanks so much.
Thank you.
We're just getting started here on Market Domination. Coming up, we have another big earnings day on tap. After the closing bell, we'll bring you the latest results from Amazon, Airbnb, Amgen, and Apple. Plus, at 4:25, it's Yahoo Finance's special coverage of Apple's second quarter earnings report. We'll be getting the instant analyst reaction to the results. And at 5 p.m., we'll take you live inside Apple's earnings call. You can scan the QR code to stay up to the second with the latest news and stock moves from the iPhone maker. Stay tuned. You don't want to miss it. The labor market, of course, in focus as we're approaching next week's FOMC meeting, and tomorrow's jobs report could be a key piece of economic data for the Fed's future interest rate path. For more, we're bringing in Nick Timiraos, Chief Economics Correspondent at the Wall Street Journal. Nick, it's always great to see you. And I guess tomorrow is sort of the first actual piece of hard data, or certainly the biggest, that could incorporate some of this tariff impact, right? Is that the right way to be thinking about it?
Yeah, so let's just get out of the way. I mean, the Fed is not going to cut interest rates next week, but the April employment number that we get tomorrow is still important because the Fed, the question right now is really how much hard data weakness do they have to see before they would cut? They meet again in June. There will be 2 payroll reports before June, so it's possible you could see 2 crummy numbers before the June meeting. And a lot of people think that would be a bare minimum. You would need to see that to get a June rate cut. So at least with the payroll number tomorrow, if it's bad, it keeps the door open potentially to a June cut, though there is a lot that could happen between now and June. And it's, it almost feels like it's a year away. If it's a good number, I think it just raises the bar somewhat because you could still see more hard data weakness, but you only have that May payroll number before the June meeting. So it just, the calendar sort of gets crunched on you there.
We covered the jobs report, Nick. What about, I'm just curious to get your take on this April ISM manufacturing reading we got to. It did remain below 50. It was sort of little change at 48.7. It was slightly above the estimate, but what'd you make of that reading?
Well, I paid closer attention to the commentary in there. They always list anonymous commentary from the purchasing managers they survey. I think there were 10 of those this time from different industries. All of them were about tariffs. You didn't see people talking about weak growth, high borrowing costs, unfavorable credit conditions. They all were focused on tariffs, the uncertainty, the difficulty, frankly, in planning for the future. So I think as it pertains to the Fed, they could face a choice here, and the choice would be between recession or stagflation. If we end up in a recession, it does not seem like the sort of thing that they are going to rush to try to preempt, because then you could be back in the stagflation scenario. So then I think the question just becomes, how bad is it? How much can the Fed cushion the hit? And you saw a whiff of stagflation in the ISM manufacturing survey because prices paid rising, employment going down, maybe not as bad as last month, new orders not great. That's different from 2021 when all of them were going up.
Nick, and then there is this sort of political overlay, right? President Trump backed off and said, I'm not thinking about firing Jay Powell, but he then has continued sort of the rhetoric of he thinks the Fed should lower rates. Scott Bessent, the Treasury Secretary, in an interview, he didn't directly say, but sort of implied he thought that rates should be lowered here. So does that, and I know that Jay Powell is staunchly apolitical, but does it raise the specter of appearances here in that sort of hang over the Fed's decision-making process?
Yes, it does. I mean, the White House is clearly taking a point of view here on what should happen with interest rates, with some threats to back it up, threats to escalate a fight with the Fed. It's a fight that I don't think Powell would back down from if it came to that, but it's also a fight that is just not good for the Fed to have. And so it's possible they're able to just filter this out and sort of rise above the noise. But they're humans, right? They're humans. And I think this sort of thing, it forces the Fed, if they're not going to cut, they have to have a very good argument for why you're not cutting here. It could be the inflation numbers. It could be the job market is doing okay. I mean, for right now, where we are here on May 1st, 2025, I don't hear anybody really arguing that the Fed should be cutting rates right now. I think the argument really is about what's coming down the transom here, that the increase in prices will not persist beyond 2025, but the weakness in the underlying economy could actually overwhelm any inflationary impacts. And so people are really having a debate, not over whether the Fed should cut interest rates at this moment. The debate is about how quickly the Fed should move once they see that weakness in the economy. We could get into a place later where we're debating 25 versus 50 when it's time to cut. How fast do you go? I think for right now, again, back to the ISM numbers, nobody's really arguing that a 25 basis point interest rate cut would do anything to resolve the headwinds facing businesses.
To your point, Nick, though, I just want to get your take on this. Ed Yardeni recently wrote about how he says there's this dovish faction forming within the Federal Reserve Board, I think how he put it, and how they believe the economy is more vulnerable and that the Fed should be acting sooner rather than later. I think he kind of framed it as sort of the Powell camp versus the Waller camp, and I'm just curious to get your take on that.
But even if you listen to Chris Waller, who publicly at least has put out the most dovish reaction function, he's saying, I don't think this will be inflationary, and therefore we can cut. And if we go into recession, we can cut more and faster than I'm anticipating right now. So, but even the most dovish policymaker, Chris Waller, is not arguing for interest rate cuts right now. Powell, I think, has adopted a position of studious neutrality. He is not saying one way or the other what they should do if they get into that situation. He's talking about a balanced approach, which is sort of monetary policy Greek. But what it means is when the unemployment rate's rising and if inflation's also rising, you look at how far each of those are from your goals, and you make a decision about which one you think will get back sooner, and you adjust policy accordingly. So it's the sort of thing where I think they will know it when they see it, but it's very hard for them to entertain these hypotheticals. Chris Waller notwithstanding, Fed officials are just not saying what they would do in that situation. And I think you see some of the disconnect right now in the market, right? The bond market is anticipating cuts. I think they've priced in 4 cuts this year. The stock market is not trading as if we're going to see the weakness that would prompt those cuts. So it's possible the bond market's right. They see economic weakness coming that the stock market doesn't. It's possible the stock market just thinks Trump is going to back down if the weakness arrives. And so nobody wants to be short here because the president could come in and change everything.
Nick, just sort of circle back around to the beginning and the jobs report. I'm curious if jobs are what you think the Fed are going to be watching most closely. Like, what's the data point that we all need to be really looking at? Not the point, but the trend of points.
Well, I think it's the labor market and inflation, which is sort of a Captain Obvious answer. But I think the question is going to be, do these tariffs, how soon do they flow through to finished goods prices, into the CPI? How much of it is absorbed into margins? and how much of that margin hit leads to less hiring. So they're looking at both sides of their mandate. I think which one shows up first could matter, because again, if you're following this balanced approach, if inflation goes up first and then the unemployment goes up, well, you do have a problem there. You have a real trade-off. If the unemployment rate goes up before you see the rise in inflation, then maybe it's easier to argue for a cut there. I still think what you're hearing from Powell is that they're certainly not going to be as preemptive as they've been in the past. But even when it comes time to cut, they may not do as much as what you would otherwise expect them to do because of the inflation situation.
Nick, always great to see you and to have you on the show. Thanks for joining us.
Thanks for having me.
Coming up, more companies are sending warnings this earnings season as they continue to navigate trade war turmoil. Stick around, much more market domination. That's still to come.
We've been watching for all the tariff mentions this earnings season. Let's round up some of the latest that we've got. General Motors, of course, is on the list. It lowered its 2025 financial guidance to include an expected impact of up to $5 billion. That's a result of President Trump's auto tariffs, of course. Tariffs also causing a pull forward for GM. According to the CFO, he said on the call, quote, the industry undoubtedly benefited from some pull-ahead demand from customers purchasing vehicles ahead of potential tariff impacts. Taking a look now at two-wheelers, Harley-Davidson withdrawing its 2025 outlook. The motorcycle maker citing a lack of clarity around U.S. trade policy and weakening economic conditions. The company making it clear on the earnings call that it is actively engaging with the Trump administration and that any further tariff deal should include the company. Wayfair not providing any guidance in its earnings report today, but the company did make plenty of tariff mentions. And while tariffs did have an impact on the company, the Wayfair CEO is remaining confident. He said on the earnings call, quote, our wide breadth of products and supply base from around the globe continues to offer us a healthy degree of insulation against tariff headwinds, and those shares are higher.
Well, CVS Health shares getting a lift as the company tops first quarter earnings estimates and boosts its profit outlook for the full year. And joining us here with more is Yahoo Finance's very own Anjali Kamlani.
That's right. You can see the stock up really significantly on the day. And that is because, in large part, it beat Wall Street estimates, but also has this really interesting new relationship with Novo Nordisk, claiming it as the exclusive partner for its formulary for the GLP-1s. That's for weight loss. There's also some other news around CVS with it exiting Affordable Care Act marketplaces. And that's something that's interesting as well, because we've seen that as sort of a trend where some of the major players in this space have definitively left the space. And that could bode poorly for consumers in the upcoming years. Medicare Advantage costs are a little bit more realigned now, so that's something good to look forward to. But going back to the CVS and Novo Nordisk deal, that is, of course, the talk of the day. If you've seen Lilly stock, it has taken a beating because of its competitor getting this deal. And what the deal entails is that self-pay patients will now get to buy the Wegovy product at CVS for that discounted $4.99 that we used to previously see just on telehealth platforms. Meanwhile, Zepbound has been excluded from the formulary, so that means it is going to miss out on those patients being steered towards it. I had a chance to sit down with CEO of Eli Lilly, and he did say to me that this is something that he sees as a little bit, quote, last decade. And so kind of indicating that he's not interested in this move and looking at it really from the perspective of, including all points of access. That includes other telehealth platforms. And we've seen Lilly Direct do just that. But I also got a chance to speak to CVS CEO, the new one, David Joyner. He's not new to CVS, of course, was previously leading the PBM business unit. So, of course, knows all about this. And his take on this was that it is actually a way to help CVS get access at a lower cost price for, of course, the formulary placement. Here's what he had to say.
This is the first breakthrough in our relationship with Novo that allows us to have a discounted product in the retail setting to be able to reach the consumer directly. And up until now, that has not been an option. And so it is a significant change from a business practice for. Otherwise, we would have had to sell it at the wholesale acquisition cost, which would have been north of $1,000. And most consumers are simply not going to pay the list price for the product.
I spoke to some analysts who also said that this was something that CVS pursued, and Eli Lilly seems to be essentially waving it off, and it might not result in sort of this price war that would ensue if Lilly does go ahead and create some sort of a similar deal with another PBM.
What about the partnerships with, though, like the telehealth platforms? How do they fit into all of this? Because, I mean, they're competition for this also, right?
They are and are not. So they have those separate relationships with Novo Nordisk and Eli Lilly. And through those platforms, you have the providers essentially writing those prescriptions that get those direct they're directly selling to the consumer from there. So that cuts out some of these middlemen in essence. We have heard from, some of those larger telehealth platforms like Hims and Hers and Ro. Those were previously selling the compounded products. So this is a move to get them away from that, essentially. Yeah.
Okay.
Thank you, Anj. Appreciate it. Seaport Research hitting Nvidia with the rare sell rating as it initiates coverage on semiconductors. Seaport noting AI is bringing about a secular shift in the industry. Jay Goldberg, senior analyst at Seaport Research Partners, joining us now to discuss this. Jay, it is great to have you here. So you initiate Nvidia with a sell. You might, Jay, per Bloomberg, be the only sell on the street. Explain the rating to us, Jay.
Great. Thanks for having me. So put simply, I think the AI story, we've been talking about it for years. We all know about it. It's fully priced into Nvidia right now. They're a good company. They make great products, but they've said already their newest line of products, their Blackwell line, is sold out for the year. They're capacity constrained. Once you're sold out, the room for upside is pretty minimal. The bias shifts towards the downside, right? There's not much they can do to get above where consensus is, but there are a lot of things that can trip them up. There's lots of small things, snafus. There's a lot of friction in the system, and I think that we should be concerned about those. And that semiconductors are cyclical, and it's important to remember that.
Jay, what about this idea that there might be some sort of potential tariff or export control relief for Nvidia that wouldn't necessarily affect Blackwell, but could affect some of its other chips?
Well, I think that there's two sides of this tariff story for Nvidia. One is their cost of importing things from China. A lot of their supply chain comes from Asia. Most of the analysis we've seen shows that that impact is fairly minimal, so that the hyperscalers, the Googles and the Amazons of the world can continue to buy Nvidia chips and import them into the country at essentially, no tariff or very low tariff. The flip side of that is what's going on in China. China would very much like to get their hands on more Nvidia chips, but that seems very increasingly difficult in this geopolitical environment. So it's less about tariffs and more about this perceived rivalry between the US and China, this AI race. And I don't see that lightening up anytime soon. And even if that does happen, it's still fairly minimal. I think there will still be some restrictions, so it won't be a quick snapback.
Jay, on the big tech companies that have reported, it's interesting on CapEx, Jay, and you've watched, obviously. You saw Alphabet reiterate, Microsoft reiterate, Meta actually raised. That would seem to be all good news for Nvidia, Jay. So I guess you're saying, yes, it is good news, but that simply is priced in at these levels?
That's right. It's priced in for these levels. And I think it's important to remember what they're talking about is CapEx for this year. It's a little early to be talking about CapEx budgets for next year. But in my conversations I'm having with everybody is there's a growing scrutiny being applied to AI spend. We've had some really, really big numbers this year from all the hyperscalers. I think we're starting to see signs that, I don't think anyone's going to cut drastically, but there are certainly signs that the finance team is starting to ask questions. A year ago, it was all AI all the time, but now the CFO has entered the chat and is starting to ask, what's the return on this investment? And just to be clear, I'm a believer in AI. I think there's a lot of potential there. I just think it's going to take us a few years as an industry to really find those compelling use cases. And as we do that, there's going to be, a sort of gravity asserting itself, and people are going to ask, what's the return on this investment? And I think that sets us up for a potential for a pause, or at least a slowing.
Jay, even as you have this sell on Nvidia, you do have a buy on Broadcom. And of course, Broadcom has gotten a lot of attention as being a company that could benefit from more companies sort of doing custom chips or contract-made chips. But when you talk about stuff being priced in, I mean, Broadcom is up about 60% over the last year. Nvidia is up about 36% or so. So how much of that outlook is priced in?
So I think what I told my sales force is that the AI story is fully priced into Nvidia, and it's not priced into Broadcom. Broadcom has a lot of other pieces going on here beyond the AI story, their networking business, their software business. But I don't think the street entirely believes their AI story. And we actually saw this. They reported earnings in December, and for the first time, they laid out their opportunity for AI, and it was large. It was a massive opportunity. Anytime Nvidia loses share today, it's to one of the hyperscalers doing their own chip, and Broadcom makes a lot of money helping them bring those chips to market. Right? So when they laid out their AI story, Broadcom was up 20, 25% on that, right? And then in January, we saw the DeepSeek story come out, and everyone had a momentary panic that we weren't going to need GPUs anymore. And Broadcom essentially gave up all those gains, right? And I think there's still a lot of show me built into the Broadcom story around AI. And the street doesn't believe it. I do.
Jay, thanks a lot. Appreciate it.
Thank you.
Coming up, we're counting down to the closing bell, getting you set for another critical round of earnings reports. Stay tuned. Much more market domination still to come. Shift4 Payments just posted a strong quarter earlier this week, beating expectations on revenue and payment volume and continuing its rapid global expansion. It also processes more than $260 billion in payments each year. But beyond the numbers, the company's navigating some strategic shifts, including the potential departure of its founder and CEO, Jared Isaacman, who has been nominated to lead NASA. We're now joined by Taylor Lauber, Shift4's current president and future CEO. Taylor, welcome here. So coming off of earnings here, what are you seeing? I mean, we are hearing about all of these sort of broader economic pressures here. I was surprised on your conference call how sanguine you guys sounded. So talk me through that sort of seeming disconnect here.
Yeah, sure. So I think it's important to maybe baseline the types of merchants we serve when you're thinking about our view into the consumer. We support about a third of the table service restaurants in the United States, about 2/3 of the hotels, and a disproportionate number of the sports and entertainment venues, theme parks, et cetera. And through that lens, we've seen a consumer that's actually been very consistent over the last kind of 18 months or so. And what I mean by that is it's a consumer that is spending modestly below what they were in the previous year, but very modestly, like 1% down, and in some cases flat to the previous year. So we're not seeing any immediate cause for concern inside the consumer. It's not to say that we don't, as a business, think about what the road ahead could look like. But the push and take to serving these verticals is that in order for us to grow as a business, and we posted 40% revenue growth over the last year, we need to add a lot of customers. We can't spend a lot of time focused on same store sales, but when we do look at the data, it tells us that at least for our vantage point, our merchants are doing okay for now.
So that's interesting because do you all, I mean, obviously you make more when you add customers, but aren't you also making, say, a percentage of your existing customers' volume, right? So don't they also have to grow ideally here? I mean, we're hearing from, Chipotle and McDonald's, et cetera, in that realm, seeing things slowing, and we're seeing it certainly show up in other places too.
Yeah, that's absolutely right. We want our merchants to do immensely well. I just think that there's an imbalance that we've seen between kind of the capital markets fears, the political rhetoric, and what's going on in our merchants on a day-to-day basis, which is, flat to modestly down, and I mean modestly, like 1% year over year, is not an immediate cause for concern inside of our merchant population. It's not to say, again, that we don't think about the future, that we don't want our merchants to grow meaningfully. It's just not the significant downturn that I think others are reporting inside of their own businesses is not something we're seeing across broad swaths of our merchant population.
I am curious though, Taylor, you saw that GDP print we got this week. To the extent that the economy would meaningfully slow or maybe even tip in a recession, that would mean what for your company?
So it's a great question. Now, we've been around for 26 years. So we've experienced lots of ups and downs from an economic standpoint, whether it's COVID, which like regulated a lot of our merchants out of business temporarily, or the great financial crisis. And generally what we see are modest single digit pullbacks inside of restaurant spending on a same store sales basis. Keep in mind, these are generally businesses, especially down at the local level, that are very elastic to consumer demand. When the $100 steak becomes intolerable, they replace it with a more modestly priced option. There are hamburgers that come in cheaper than that, et cetera. So our merchants have been found a way to react pretty quickly to consumer spending. But in the case of obviously, a consumer that is broadly impacted, they do spend less in our locations. But what we've seen, and I think this should be reassuring to many that are worried about, the economy, is in a lot of these consumer discretionary verticals, consumers do go. They simply pull back and their average tickets are lower, et cetera. But, one of the last things that we found consumers are willing to part ways with, in good times and in bad, is the ability to go out on a beautiful day like this in the New Jersey area and go out with your family for, a burger and a beer.
You mentioned earlier that, you also are looking at customer acquisition, right? And you already have grown a lot by acquisitions here. Or do you think that the sort of turmoil that we've seen in the markets provides that further opportunity to maybe scoop up some assets at reduced valuations here? Is that part of what you're planning on for the rest of this year?
It's a great question. I would say at the current moment, this kind of volatility actually doesn't present a lot of opportunity. And what I mean by that is when everyone's uncertain about what the next few years are going to look like, or even the next few months, they simply don't make decisions. Contrast that to the past year where we acquired, 5 phenomenal businesses that we've been trying to work on for many years. There was a lot of opportunity for M&A in that environment, and that was something like the uncertainty of a political election where you kind of had 2 paths. It could go down, but it was going to go down one of those 2 paths. In the current environment, we're actually having less M&A discussions because I think business operators want to pause and understand what the next few months means before they make a big decision, like do they want to sell their company or not. However, we already did disclose that we are in contract to acquire the largest acquisition in our history, a company called Global Blue. So, and that was agreed to just a few months ago before the recent kind of market turmoil.
And now I guess it's digestion time, and I'm focusing on closing that. Taylor, thank you so much. Appreciate it.
Thank you.
Now time for some of today's trending tickers. We're checking on how Meta and Microsoft's earnings are affecting data centers, plus an executive shakeup coming at Kohl's. And the latest earnings from Becton Dickinson has those shares in focus as well. Let's start with the impact we're seeing from Meta and Microsoft, announcing they don't seem to be slowing their spending on data centers. Had shares of companies like Oklo, Vertiv, CoreWeave all up in today's session. And of course, Josh, what we saw is that Meta actually raised its CapEx forecast, which was surprising. Microsoft's CapEx last quarter actually slipped a little bit, but Amy Hood has said they're going to continue to grow. They're going to continue that spending on data centers. So, we definitely over the last year have seen these phenomenon where there's this broad universe of stuff that is both directly impacted by data center spending and indirectly, and it tends to move together when you get headlines.
And it's interesting, and we talked a lot about this heading into this earnings season. That was such a big question about the AI boom, and would the biggest companies on the planet keep spending as much on it? Now, granted, after the bell today, we got another 2 big names, and we'll wait to hear what they have to say. But so far, to your point, Julie, on CapEx, Alphabet reiterated, Microsoft reiterated, to your point, Meta raised. At least for now, they seem to be saying and suggesting to their shareholders and investors they think this is the wise move and they see a return on it.
At least for the moment.
Yep. All right, meanwhile, Kohl's board of directors has ousted CEO Ashley Buchanan for cause, citing violations of company policies related to undisclosed conflicts of interest in vendor relationships. So this one, Kohl's fires its CEO, that's Ashley Buchanan. Board says he had the company, I guess, do business, Julie, with someone he had a personal relationship with. They call it on highly unusual terms. Remember, Buchanan is relatively new here. He only arrived in January, I think. Chairman Michael Bender will now serve as interim CEO.
I mean, Kohl's has already been struggling, right? The shares are down sharply year to date, about 50%. It suffered from waning sales here, so Buchanan was supposed to come in there and hopefully revitalize things, and so now seeing yet more turmoil. On the plus side, the company did come out with preliminary numbers for its first quarter, and their sales fell 4 to 4.3%. That's actually a smaller decline than estimated, and the company's preliminary loss per share of 20 to 24 cents is a smaller loss and therefore better than the 48 cents that analysts were looking for.
I did see analysts from Global Data cited saying, gives the impression, talking about this news, that Kohl's is in a perpetual state of chaos. And they go on to say it raises some questions about the due diligence over his appointment.
Interesting. All right, and then we got shares of Becton Dickinson sinking after the medical technology company reported second quarter sales and profit that fell short of estimates. The firm also lowered its adjusted earnings per share guidance for the full year. Now it's looking for $14.06 to $14.34. The previous guidance, $14.30 to $14.60 here. And it does seem like some of this has to do with the macro environment and what we're seeing.
Yeah, CEO saying amid a difficult operating environment impacting near-term organic revenue growth, our Q2 results reflect the strength of our business model and ability to exceed our earnings expectations through quality gross margin improvement. So trying to sound a positive, confident tone there. Bloomberg analysts weigh in, by the way, say its miss and guidance cut saw deceleration in organic growth even when accounting for a tough comparable as disruptions from its pending spinoff were evident.
Yeah, worst performer in the S&P today.
All right, while we are wrapping up today's market domination, don't go anywhere. We've got you covered all the action following the closing bell, including the latest round of earnings results from Amazon, Airbnb, Amgen, and many more.
Including at 4:25, Yahoo Finance's special coverage of Apple's second quarter earnings report. We'll be getting you instant analyst reaction to the results, and at 5 p.m. we'll take you live inside the Apple earnings call. You can scan the QR code to stay up to the second with the latest news and stock moves from the iPhone maker. Stay tuned, you don't want to miss it.